Springs and Terminal Shakeouts, Lecture 5. The subject of this lecture is springs and terminal shakeouts. The purpose of this lecture is to discuss with you the phenomenon of a terminal shakeout, the spring and where they fit into accumulation, how you can use them, how you can take a position on the spring or the terminal shakeout, and how to train for maximum potential profit with a minimum of risk. First, let us define a terminal shakeout. A terminal shakeout is a sharp downward thrust through a previous support area. It is executed for the purpose of buying all the stock possible from weak or vulnerable holders. It is preceded by a trading range or a support level. It is followed by an attempt to begin the markup phase of the cycle. The terminal shakeout is a drive down through the support level for the purpose of shaking out all of the people who can be scared out or forced out of the market and forced to sell. Now, why start this lecture with the terminal shakeout? Simply because that was the term and the concept and the understanding that the old-time professional stock operators used. It is the understanding and the terminology that Mr. Wyckoff passed on to all of us. Now, what happens to the people on the terminal shakeout? In other words, who does what to whom? It's largely the untrained people, the public, who sell on the terminal shakeout. These are people who bought at higher prices and now see the stock going to new low ground, which some people think is the worst thing that can happen. They look at what the stock is doing, not how it is doing it. When the stock is driven into new low ground, it often looks disastrous. It may look as though it is going to resume a downward trend or start a downward trend. When it makes a new low, that it is going to continue to go down, down, down. If these untrained people are doing the selling, who is doing the buying? The professionals are buying. The pros, or shall we say the composite operators, who have been absorbing the stock and are now buying the stock, attempting to see if they can control the stock so that they can begin moving it up. The critical thing that is shown by the terminal shakeout is the amount of supply that comes out on that shakeout and whether or not that supply is absorbed. Remember this vital point, it is important. A number of years after Mr. Wyckoff's passing, a refinement of the terminal shakeout was developed by Mr. Robert G. Evans, former president of our firm. This refinement is the spring. The spring came out of our understanding of the terminal shakeout and is similar to it. However, at the Institute we use both terms and both understandings. We use the spring to refer to a short, sharp downward thrust through a previous support area for the same purpose of buying all the stock possible from weak or vulnerable holders. We now use the terminal shakeout to refer to a longer or a larger sharp downward thrust through a previous support area. The main difference between the spring and the terminal shakeout is how far below the support area the drive down goes. And the difference is largely a matter of depth of penetration into new low ground. They both accomplish the same thing. They enable professionals to buy up all the cheap stock they can, to put people on the sidelines so that they do not buy in the early stages of the up move. The spring and the terminal shakeout give a completely false impression as to the direction of the ultimate move. Again, their purpose is to determine the amount of supply that comes out on the drive to new low ground and how well that supply is absorbed. Most of this lecture will be devoted to the spring, of which there are three types. A number 1 spring, a number 2 spring and a number 3 spring. They are used to define the degree of supply that comes in on the drive to new low ground. Now, what can happen if the stock goes into new low ground? It can have overwhelming supply, and if it does, we call this a number 1 spring. This is evidenced by a very heavy, overwhelming, sudden increase in volume, and the price spread is wide, volume is massive, and people are dumping stocks. There is an extreme price weakness and the stock goes down, down, down until the downward trend can finally be halted. The second alternative is that no supply is dumped on the market, no increase in supply can come out on the drive to new low ground. We call this a number 3 spring. The number 3 spring is evidenced by a lack of an increase in the general level of trading. Any increase in volume, if at all, is very, very minor, and there is a lack of important price weakness as it goes into new low ground and the spread does not materially widen. Now, there is a very large area between the number 1 and number 3 spring in which there is some supply. We call this a number 2 spring. The supply on the number 2 spring is evidenced by some increase in price weakness. In other words, some increase in the widening of the spread as it goes into new low ground and some increase in the volume over the general level of trading. Supply is not absent, but it is not overwhelmingly abundant. That supply will either be absorbed or it will not be absorbed, and the supply will persist and persist, driving the price down and having the same effect as a number 1 spring. Please turn to chart number 1, which is AT&T 2015. The stock was locked in a trading range between $30–$34 starting in August 2014. It experienced a spring early in the trading range, and as the composite operators were preparing for the markup phase, they took the stock down into a shakeout. A high-volume, violent break of the $30 support level. It penetrated below the support, supply was absorbed, and it appeared a successful terminal shakeout. The stock recovered